Good afternoon, and thank you for joining us today. Today's presentation is on evaluating sales tax risk and mitigation options. Your presenters today are Brian Greer and Jeff Meggs from Tax Connects. Just a few housekeeping items before we get started. All your lines are on mute and will remain on mute throughout the webinar. There will be 3 polling questions throughout this presentation. And as a reminder, this webinar is not eligible for CPE credit. We're providing a copy of the slides, which can be found in the handout section of the GoToWebinar panel, and a recording will be emailed out later this week as well. If you have any questions, please feel free to submit them within the questions box on the GoToWebinar panel. There should be time for a Q&A at the end of today's session, but we can also take questions as they come in, so please feel free to submit your questions at any point. We'll do our best to get to all of them, but if there's anything that should be answered in private or we can't get to them all, we'll respond to those afterwards via email. Thanks again for joining us, and with that, I'll pass it over to Brian.
All right, thank you, Kate. Appreciate that. And just a kind of a quick introduction for myself and for Jeff. We've worked together in some capacity for close to 20 years or so, maybe even a little bit longer than that. I've been in sales tax for about 23, 24 years myself, and I think Jeff 30 plus years. So certainly got some veterans here, I guess, on the call. So hopefully we can impart some wisdom as we go through the presentation today. If you're not familiar with our organization, some of you may have attended our webinars in the past. I'll give you kind of a quick sketch as to who Tax Connects is. But if you look at our business, we're a technology-enabled financial services business focused in sales and use tax. So what does that really mean? There's really 2 different types of services that companies come to us and where we help people. The first really is what Jeff heads up, and that's our consulting and advisory practice. So a lot of what we're talking about here is really topics and questions that Jeff fields on a day-to-day basis. Where do I have nexus and where do I have taxable sales, and what type of risk and exposure do I have in my business, and how do I fix that moving forward? So that's one aspect of our business, and the other is a compliance outsourcing service where we essentially become an outsourced sales tax department for our clients and prepare and file the returns and remit the payments and really just manage that kind of that administrative burden and take that off of our clients' shoulders. So that's kind of a quick sketch of who we are, what we do, but looking at the agenda here, the title here is very spot on for what this is about today in terms of evaluating sales tax risk and talking about mitigation options. And a lot of what I just described is what we're going to be talking about in terms of what Jeff works with on a daily basis, specifically talking about how to identify where you have sales tax nexus and what that concept is. I suspect most of you are at least somewhat familiar with Nexus, but we'll have a review of that here for you. We'll talk about the taxability of various products and services, some techniques to at least estimate the exposure in your business if you do discover that you should have been collecting sales tax historically. And then we'll go through some mitigation type of options, for example, a voluntary disclosure. We'll talk through that process and what some of the benefits of a VDA are. And then, depending on timing, we do have managing a sales tax audit on here as well. Hopefully we have time to get to that. We'll see, but that'll be the last topic here for the day. So without further ado, Jeff, I'll turn this over to you, and we can talk about Nexus a little bit.
Thanks, Brian. I don't know how to feel about your confidence level in my ability to speak through all of these sections and get them all done within the hour, but we'll give it a shot. As Brian said, the first thing we tend to look at for companies when we're evaluating in any sense or form sales tax is whether or not that company has nexus for sales tax purposes. Nexus being just another term for a connection. In the world of sales tax, it basically means you are physically or economically present in that state to a degree where that state can enforce their sales tax laws on your company. There are thousands and thousands and thousands of companies that are out there that have nexus in various states and have no sales tax responsibilities whatsoever. So nexus in and of itself is not a determination of your tax exposure or risk, but it is that first question or that first step in the evaluation process. When we think about sales tax nexus, there's kind of this historical standard, which is a physical presence test. And so for the last 60 years or so, if you had some level of physical activities or physical presence in the way of employees or brick and mortar stores or inventory, things of that nature, you would have established nexus with that state. There are some evidences of physical presence that are a little bit unique and maybe not as obvious. Attending trade shows is one of those, but the one that's caught most people by surprise is engaging subcontractors. We've seen companies that have decided to do business with a customer in another state, and there needs to be some installation of some tangible personal property as part of that transaction. And we engage, or the client or taxpayer engages a third-party local resource. Maybe it's an electrician who's local to that specific customer to go in and implement or install whatever it is they're trying to sell. Well, that engagement, that leveraging of that third-party resource, that subcontractor, is a form of physical presence. You've established a presence or a nexus with that particular state. So it's just important to understand sort of the sort of different varieties and variables that could trigger nexus. For the last 5 years, and it doesn't feel like 5 years to us, but it's relatively recent in terms of the history of nexus and the determination thereof. But in the last 5 years, we've had what we refer to as an economic standard for nexus, meaning you don't have to have a physical presence. You can merely have a level of revenue derived from customers in a specific state that will enable that state to enforce their sales and use tax laws on you. Generally speaking, there's a $100,000 threshold. And once you've hit that threshold, you should be asking yourself, now that I have $100,000 in revenue from this state, do I have nexus for sales tax purposes? And if so, do I need to take some further steps to evaluate my business activities? So that's sort of the way to think about economic nexus. There are other elements or variables associated with economic nexus, but that $100,000 threshold is the key to kind of keeping your eyes on the road. There are a number of states that also have transaction thresholds. In essence, even though you may not meet the $100,000 threshold, if you've got 200 or more transactions in a given 12-month period, that in and of itself could create nexus for sales tax purposes. But I think it's fair to say that if you're keeping your eyes on the road on the $100,000 threshold year over year, that's a good way of just monitoring your presence and your activities. Having said that, did you have a question come up?
No, I didn't. I know I was like looking at you, but no question yet.
So nexus being step one, yes or no. If the answer to that question is yes, I have established nexus either via physical presence or an economic presence, now I have to evaluate my business activities. What am I doing that may drive a sales tax responsibility? And those typically fall into two primary categories. Either I'm selling tangible personal property or I'm providing or performing some type of service. Now, on the tangible personal property side, in all those states that have a sales tax, if you're selling tangible personal property, it's taxable unless there's some exemption that might apply for a specific customer. So if you are in the business of selling tangible personal property and you have hit either a physical presence or an economic standard threshold in a state, you likely have the potential for taxable sales, in which case you would have to start to comply. When we get into services, the realm of services is such that there are some key areas where taxability does apply to services. It could be services that are ancillary to the sale of tangible personal property, like the example I gave earlier about having installation services that kind of go along with the sale. There are other services like telecommunication services, technology services, software as a service. There's our services. We as tax preparers on behalf of our clients are service providers, and in the state of Georgia, those services are not within the framework of the sales tax laws. So we don't charge sales tax on our services here in Georgia. We clearly have Nexus here in Georgia. This is our headquarters, and we've got a number of employees here. So the Nexus question is a yes or no. If the answer to Nexus is no, you need not go further. You need not evaluate the taxability of your products or services. If the answer to Nexus is yes, take that next step, get a general idea or perspective on whether or not your products or services would be deemed taxable in that particular state.
So Jeff, I will add one comment to this Nexus evaluation piece of it, and it's something that I think a lot of people that we talk to kind of get tripped up on, and they might ask the question, so if I have a physical presence in a particular state, but I only sell, let's say, $50,000 of taxable services or products there, so I'm under the economic nexus threshold, do I need to do anything?
Yeah, statutorily under those conditions, yes, you would have an obligation to register and comply for sales tax purposes. It starts to become a business materiality discussion, but there's risk in that. And I encourage you, if you're on that sort of border of material sales or material revenue, and it's a taxable activity in that particular state, and you do have physical presence, I would at least consult with somebody to have the conversation. Should we go ahead and register, or are we in a position where we could wait and maybe absorb some risk for a period of time before we have to dive in and start to manage compliance? So now let's kind of go through a scenario where we've evaluated Nexus and we've determined, yes, we have Nexus in a number of states. We've evaluated our products, and yes, we do make sales of tangible personal property, which can be and are likely taxable in a number of states. We do maybe also have some services that might be taxable in a few states. So if we recognize that or come to that conclusion, at that point, it's a good idea to kind of get a feel for where are we exposed and to what degree are we exposed. And in determining that, there's a few key things you want to think about. Obviously, we already talked about the taxability of products and services, but what about the taxability of our customer base? Are we selling to government agencies? And in some states, sales to state and local governments are not taxable. In other states, they are taxable. Are we selling to nonprofit organizations? In some states, they may be exempt. In other states, they might not be exempt. So there's a plethora of potential customer types that could exist. Maybe I'm selling into the manufacturing industry, and I'm selling equipment that's used directly in the manufacturing process. There are lots of states that provide either exemptions or tax benefits associated with those kind of sales from a sales tax perspective. So understanding the customer base is important. I'll kind of elaborate just a little bit on the customer base side of things, and it's kind of the last bullet on this slide. And that being, because I might sell to a customer who's legitimately and statutorily exempt, I still need to document that, and I need to get some level of documentation from that customer. We call those exemption certificates. If you're in the retail business, you're used to dealing with resale exemption certificates. And the exemption certificate world is kind of unique because there are certainly states that have their prescribed forms that need to be used, but in a lot of states, they'll actually let companies do custom exemption certificates, so long as they contain the criteria necessary to validate that the company is exempt. That validation criteria usually is comprised of the company name, address, their sales tax registration number in that state, a description of what they're buying, and then it usually needs to be signed and dated. I'm not suggesting all states allow that sort of flexibility, but I only pointed out to say that there can be an unlimited number of formats that you might receive in the way of an exemption. Some may not be valid. So it is important to understand what is valid, what is acceptable in a particular state. But it's not sufficient to just draw these conclusions that your customers exempt because they're manufacturers or because they're a nonprofit organization. You still have to get the documentation. The form has to drive the substance. The other thing to consider when you're looking back, let's say you've kind of established that Nexus has existed for you for a number of years, is the statute of limitations. If you're not registered and compliant for sales tax purposes, there generally isn't a statute of limitations that the state has to abide by. They can come in and assess you as far back as they'd like. Generally and administratively, in the case where you're not registered, the state's not going to go back much further than 7, and sometimes they'll try to go back as many as 10 years. Unless there's some fraud that they've discovered or uncovered, or taxes you've collected during a long period of time, if they uncover something like that, there's no statute on those circumstances. But if I'm really just operating in good faith, I've been operating for the last 5 years, and I've got Nexus in 3 or 4 states, it could be that statute of limitations, the general statute of limitations, might be of some benefit or at least relevance to me. And we'll talk about why that is here in just a second. But anyway, estimating your exposure is sort of a compilation of, do I have Nexus? Are my products and services taxable? Are my customers generally considered taxable activities?
All right, let's take a quick pause here, and I think we have a polling question that we just pulled up on the screen here. And while you answer that question or answer that poll, we do have a question here that I'll throw out to Jeff. Amy asked, if our only activity is sales for resale that are not taxable to the ultimate consumer, do we need to do anything further? Is that a no to the Nexus question?
Yeah, it probably doesn't answer the Nexus question. So you could, in that particular example, you may very well have Nexus. And the question becomes, do I have an obligation to register and comply for sales and use tax purposes? And because 100% of your customers are resellers, and we assume they have the ability to issue a resale exemption certificate to you, I would just encourage you to make sure you get all of those exemption certificates in hand. And what I typically will advise clients is, even if you don't have Nexus, go ahead and request the resale exemption certificate or any other exemption certificate for that matter, because you just never know when or where a state might come about to assert that you do have Nexus. And in that event, if you've got the exemption certificates, regardless of whether you have Nexus or not, you're probably going to be able to walk away unscathed. So the big message is, in that scenario, get your exemption certificates. I will tell you that statutorily in many states, even though all of your sales are wholesale or for resale, many states statutorily would still require you to register and comply, which means you may have periodic filings, even though they all might be zero dues. But the practical application is most companies, I won't say most, a lot of companies under those conditions will choose not to register. They'll just make a really strong effort to make sure they've got all their exemption certificates.
So Amy, hopefully that addressed your question. If not, there'll be an opportunity to reach out to us at the conclusion here.
So now that we've kind of made some observations that concluded we did have Nexus, we do have some taxable transactions, we do have some exposure, what do we do next? What do we do with that? Do we just sit there and twiddle our thumbs? Do we register? Do we try to do something to mitigate that exposure? There are a few options that exist out there for companies. The most common are either going ahead and registering prospectively, meaning you're registering effective today and you're going to start charging and collecting, you're going to start complying on a prospective basis only. Another option might be to register, and at the time of registration, go ahead and indicate that you should have been registered, or your effective date of registration should have been, let's say, January 1 of 2022, in which case, once you submit that registration, the jurisdiction is going to require you to file all the prior period returns from 1 of 2022 or January of 2022 through current. And in that capacity, as a registered dealer with that ability to file those returns, if there was taxable activity in those periods, you would report them. The standard operating procedure would be that the state would then impose penalties and interest on each of those filings. You may have an opportunity to mitigate those penalties. You won't have an opportunity to mitigate the interest. The interest is going to apply and it's going to stick. But I would say that there's probably some opportunity under those conditions to get some relief from the penalties. And then lastly, the more common sort of mitigation process that we follow is a voluntary disclosure agreement. We refer to them as VDAs. The voluntary disclosure agreement process is really a formal process in almost all the states. It affords you a number of different benefits, and we'll talk through those here in the next couple of slides. One of the things that you want to recognize, however, as you get into compliance, whether you do a current and prospective registration, whether you do a prior period registration, or even whether you're doing a VDAs, understand that not all states are equal when it comes to the way sales taxes are administered. There are states like Colorado, for example, which has what we refer to as home rule jurisdictions. These are cities that actually administer and establish their own sales tax ordinances, and you have to separately register with these cities, like the city of Denver. So not only are you having to comply with the state of Colorado, but you also got a city compliance requirement as well. This is true in really there's 4 states where this is primarily true, and there's a 5th state that's always a little bit of a pain. The 4 states where this is generally true would be Colorado, Alaska. Interestingly, Alaska does not have a state sales tax, but they do have a number of cities that administer or have their own sales tax ordinances. So Colorado, Alaska, Louisiana, and Alabama. Now, what's interesting about all of those states is, as I said, Alaska doesn't have a state-level sales tax, so you have to revert to the city-level ordinances to determine taxability. Colorado is somewhat similar. There's quite a big difference, or it can be, between the taxability of a product or service at the state level versus the local level. Tangible personal property, really no difference. It's at the service level where you'll see those key differences. You'll see fewer differences in the state of Louisiana between the parishes and the state. Parishes generally follow the state rules. There are some exceptions to that. And then lastly, in Alabama, for the most part, the Alabama locals or home rule locals do kind of follow suit with the state. There are a few unique exemptions or scenarios, I should call them, that might be a little different between the state and locals, but generally is pretty good match. As you get into this sort of mitigation effort, or maybe you're getting registered, just note the fact that you may have some of those other city level registrations. And it did say there was a 5th state, that 5th state being Illinois and the city of Chicago. The city of Chicago is the only city in the state of Illinois that has what we call home rule taxes. Now, when it comes to tangible personal property, the state actually administers the Chicago sales tax. So it's not really that unique in that regard. But what does happen is there's a number of things that are exempt at the state level. For example, software as a service is exempt at the Illinois state level. The city of Chicago, however, does have a tax on software as a service, and it's a 9% rate. So it's just important to understand that there's some uniqueness to that state and to that city. When we get into a VDA scenario, there's, as I said earlier, there's sort of a few key benefits, and these are pretty consistent across all the states. There's always, the thing about sales tax, just to kind of pause for a moment, is that the reason it's so incredibly difficult, particularly for companies that are operating in Europe or outside the U.S. and they've been used to this VAT, value-added tax concept, and they all of a sudden do business in the U.S. and they have Nexus, they're overwhelmed with the variables, the uniqueness of it. and it's always it depends on so many other factors and circumstances that it's almost mind-boggling for some of those types of companies to adapt to it. We've kind of grown up in this environment, so we're kind of used to it. But there's about 12,000 different jurisdictions that there's taxes attributable to here in the U.S. That's a lot. But I kind of digress. Going back to the voluntary disclosure agreements, what are the real benefits to that? And as I talked about it, there's some nuances, there's some differences, but generally you're going to get what we refer to as a limited look-back period. And when I say limited look-back period, that is usually the standard statute of limitations that the state has for a registered taxpayer. So in a previous slide, we talked about a 36 to 48 month sort of time frame. That's typical. Most of the states are either 36 months or 48 months. And when you go through the voluntary disclosure process, if you're disclosing that you had nexus and should have charged tax, you're going to get the benefit of that look-back period limitation. What does that mean? Well, that means if I've got liabilities that are 7, 8, 9 years ago, I had nexus, I should have charged tax, but didn't, the state's going to forgive that liability. The second key benefit is penalty abatement. And a lot of companies and a lot of taxpayers will look at voluntary disclosure agreements and they'll really get enamored by this penalty abatement, penalty relief. And it is a big deal. I mean, a lot of times it's 25% or more, and that's a big number. So there's an infatuation sometimes with doing VDAs just to take advantage of that. The realities, though, as we have experienced, are that if I didn't do the voluntary disclosure agreement, and if my circumstances were such that the liabilities and the risk was all contained within the last 2 or 3 years, I might be better off doing something prospectively. I might be better off saying, look, I recognize I probably should have done something in the past. I didn't charge or collect tax, so it's not like I'm holding any trust funds of the state. But I don't really have a lot of cash to go back and mitigate that liability either. I don't want to continue out of compliance. I do want to get into compliance and stop the bleeding, so to speak. And so maybe I register prospectively, I comply prospectively, and then 2 years, let's say I'm audited under those conditions. The state discovers I should have been registered in those prior periods. They assess me. They'll put penalties. They'll put interest on it. It's very likely under those conditions, if there's no fraud, there's no tax collected, that the state would be agreeable to waiving or reducing that penalty in that audit. And so essentially, you're getting the same benefit that you would have gotten originally out of the voluntary disclosure agreement, taking that approach. It's not that I'm encouraging that approach. What I'm really encouraging by giving that story is compliance, prospective compliance, but really voluntarily complying. The states are dependent upon taxpayers voluntarily complying. They don't have the resources to audit everybody. They're not going to find everybody. You don't want to necessarily be in the position where you are found, obviously. It can be detrimental to the business, can have a significant financial impact. But at the end of the day, the sooner you get registered and the sooner you start voluntarily complying, the better it is for you as a company and the better it is for the states. Everybody wins. So we're not encouraging you not to deal with prior period exposure, but recognize sometimes companies don't have the ability to deal with it. We had a client up in New York a number of years ago who was just in that same situation. They absolutely understood they had nexus. They understood they had a prior period exposure that was massive, very, very significant. And what they decided was, we're afraid of registering because we know when we register, we have to kind of put our name on things and sign off on things saying we're going to start complying, and we kind of set the effective date. So they were afraid of doing that, and they didn't have the ability to mitigate the prior. They went another 2 years and basically just accumulated another about $1.5 million in risk and exposure. And then they wanted to have a liquidity event. And when they did, the buyer did due diligence, and they had to go back and mitigate all of those tax liabilities. So at the end of the day, you're eventually going to have to pay up. So the sooner you can get into compliance voluntarily, the better off you'll be. So is a VDA right for your business? I kind of hinted around a lot of this already. I think if you're in a position where you've got significant exposure 5, 6, 7 years ago, that you haven't charged tax, but you should have, that the VDA program can be extremely attractive. You're really getting a free pass for those older liabilities. You will have to pay interest. That's not going to get waived. But to the extent you didn't collect tax, you'll get the waiver of the penalties as well. If you are in a business that's looking to have a liquidity event in the future, whether that's 2 years from now or 4 years from now, understand that in our world today, sales tax is a pretty big ticket item when it comes to due diligence. It's something that's not ignored as it might have been 5, 10, 12 years ago. Almost every company that buys another company is going to evaluate their sales tax risk. It's going to either hit the escrow or it's going to reduce the sales price of the business. One way or another, it's going to get paid and dealt with. So VDAs can be very attractive under the right conditions. It's just important to understand all those facts and circumstances. And again, I don't want to discount the fact that different states have different rules when it comes to VDAs. And I've been hinting at the fact that VDAs are great when you haven't charged tax. VDAs can be great when you have charged tax as well. Let's say your systems and your processes went ahead and started calculating on tax on invoices, and you started billing it, you started collecting it, not realizing you had some risk there and needed to get registered. So you went a couple of years collecting without remitting. That is typically something that does qualify for the voluntary disclosure process. Just note that there are some states that they don't like that scenario, so they'll let you participate in their program, but they're going to assess you some level of a fee or a penalty on that tax you collected and didn't remit. It's going to be less than the original penalty would have been, but they'll still impose some level of penalty. It's about 4 or 5 states that do that I recall. So I don't want to discount those of you that might be in a position where you've collected tax. I don't want to discount the VDA programs under those conditions.
All right, I think we've got our second poll question here, and just kind of an interesting side note with these VDAs as well as the economic nexus that we talked about initially. If you look at our business in general, we didn't do a ton of VDAs probably 2 years ago, 3 years ago. And the dynamic that was in play is a lot of these businesses were establishing sales tax nexus by virtue of the economic nexus, by virtue of that Wayfair court case, and they may have only had 6 months or a year or 2 years of sales tax liability to mitigate, and it took away a lot of the value associated with that limited look-back period on the VDA. And now it seems like we're seeing a little bit more interest in people wanting to mitigate, because now they've got 5 years post Wayfair, they've got 4 years, 5 years of liability in that limited look back period, especially in a 36-month state, and to be able to chop off 2 years of risk can be pretty attractive for somebody. So it's coming back into the forefront, I guess.
Coming back in vogue.
Exactly. So couple of questions here before we move on to I think the audits is the last piece here. Gene asks us, do you find that if the state does catch you not filing, do they report you to other states?
It's a good question. It can happen. There are regional, I'll call them associations. I forget what the real right term might be for these things, but there are consortiums of states that have come together. I think there's 9 of them here in the Southeast. There's one out in the Midwest. And these states have kind of come together and formed a little bit of an alliance. And there are certain circumstances under which they can and will share information across state lines. It's not everything. I think there are limitations. I think there's some legalities that do restrict them to some degree. I can't speak to that much more than what I just said. So I think yes, and there's a general potential of that happening. we rarely see it happen. And when I say we rarely see it happen, I think what we're saying is we're not necessarily seeing one state bordering another state, and one audit starts, and then 6 months later the other audit starts in the other state, and lo and behold, we had similar liabilities. So I can't say we've seen a lot of that. I'll tell you where I know that it happens. And I don't know if we talked about my background, but I was in audit for the earliest part of my career. Jewelry and art. Jewelry and art is fraught with fraud because you've got something that is extremely small, very easily transported, and extremely valuable. And so the common practice that these companies would exercise, and I'm not pointing at these industries and saying that they're illegal people. I'm not saying that at all. But there just have been historically propensity for these transactions to not fall within the guidelines of sales and use tax laws. So I walk into a jewelry store. I live in Atlanta, Georgia. I walk into a jewelry store in Charleston, South Carolina, and I see this magnificent ring that I so want to buy for my girlfriend or my wife. Let me clarify that part. And I go in, and this thing's very expensive. And the sales tax rate in South Carolina, let's call it 6%. So it's a $10,000 ring. That may or may not be expensive to some of you. And so I've got a $600 sales tax liability. Or I can instruct that jeweler to send it to me and ship it to me in Georgia and say that it was an interstate transaction. And most jewelers don't have nexus across state lines. They're usually independent owners, proprietors. So what they're really shipping is an empty box. They're giving me an invoice that says this was a sale of a ring of $10,000 shipped to Atlanta, Georgia, and shipped via common carrier. They will literally package up a box full of nothing and ship it via common carrier, insure it for $10,000, and I will never pay $600 in tax. Now, the reality is the statutes in Georgia require that if I do that, I have an obligation to report that transaction on my income tax return and pay that, whatever the tax rate is in Atlanta on that product. But as you can imagine, those people generally don't get caught, except for what happens is South Carolina goes in and audits that jeweler, and they come across these transactions, and there's 15 different customers that bought $10,000 to $50,000 worth of jewelry and had it shipped to Atlanta. They'll record that information. They'll send it over to the Georgia Department of Revenue and said, you might want to see if these folks reported their use tax on their income tax returns. Fairly simple audit, quick payback. So that's where it happens. If you want to know more about some of the scenarios, the former CEO of Tyco up in New York did this with art, $1 million pieces of art, where he had empty boxes shipped up. I think he had a vacation home in Maine or somewhere. But in any case, he ended up going to prison for a number of things, one of which was this fraudulent sales tax avoidance on art. That was a long answer to a short question, sorry.
Good stories. We've got a couple of questions that I think we'll save for the end, and we can get through the audit piece here and then hit these last couple of questions we've got.
Yeah, so I get asked this next question a lot. How are companies selected for audit? Or it might come in the form of, what are the chances I'm going to get selected for audit? It's a guess at best. There are a number of ways that you might be identified for audit. I just told you the story of the Charleston jeweler. Maybe you're identified under that condition. But it is actually fairly common for audits to originate from the audits of other companies. So I may be, as an auditor, I'm auditing ABC company who has been buying a lot of product from XYZ company. And XYZ company doesn't show up when I go and look them up in my state logs for sales tax registration. I don't see them registered. But I know for a fact they sell to the ABC company enough that they've triggered economic nexus at a minimum. So I may put them on my notepad as, this is a good interstate audit candidate. We may want to go take a look at this company. So invoicing activities, business-to-business transactions, definitely. There are becoming a little bit more aggressive in the way of nexus questionnaires. This is happening in these states after Wayfair, who have started to say, well, why don't we just ask a few more questions after the registration? How much revenue did you make from sales into our state over the last 2 years? And they'll kind of trick you. I don't want to say trick you. They'll kind of pressure you into giving that answer. You really don't have a lot of choice once you're registered. And then there's nexus questionnaires that come out regardless of whether you're registered. They're fishing expeditions. What used to happen 15, 20 years ago is we would get this nexus questionnaire in the mail from a state, and we would just encourage the taxpayer to ignore it. And then they might get a second questionnaire or a second follow-up inquiry. We would again tell them to ignore it. Usually it went away. Those don't go away anymore. The states are a little bit more sophisticated. They've actually got computers, and they're keeping track of who they're sending these out to. So they're following up, and they'll just start an audit if you're not careful. And then if you've got some history with a jurisdiction where you've not, had good audit results, you probably can expect them to start a new audit within the relatively short time frame of the end of the last audit, or at least within that statute of limitation. They won't let the statute run. There sometimes can be industry-focused audits where there's something going on in the industry and something's kind of new innovation, new product, new service type has kind of been introduced to the market, and the statutes haven't kept up. The administrative policy hasn't kept up with how to tax it. And so it might be time to do an industry audit where they may target 5 or 6 companies in the same industry to make sure there's consistency. And in that case, they're not only looking for liabilities and risk, but they're also wanting to make sure that there's a level playing field for everybody doing business in that concept. The last one I'll just touch on briefly is disgruntled customer or disgruntled employee. I've been involved with both, where companies have been sort of targeted by employees that, for whatever reason, fell out of sorts with the company, and maybe they had information or knew of information that was detrimental to the company. So it's a real issue, it's a real exposure, but if not for the sake of this employee calling the jurisdictions, none of the jurisdictions would know about it. So without going into some horror stories on that one, which might take us over our time limit, I'll kind of move on to the next slide. But those are kind of the primary reasons or ways companies are selected for audit for sales tax purposes. Lastly, managing a sales tax audit. So whether or not we've been registered and filing regularly and doing all the right things, or we haven't been registered and we know we had Nexus, maybe we didn't know we had Nexus, but the state knew we had Nexus, and we've got some exposure, we get that knock on the door. It's usually not a knock on the door anymore. It's usually a letter in the mail, or could even be something that comes through email. And the state gives you the notification they intend to conduct an audit for sales tax purposes. In a lot of states, when they do an audit for sales tax purposes, they'll do a cursory review for other tax types as well. That might include income, might include payroll, might include property in some cases. But a lot of times, sales taxes is sort of the direct target of a lot of audits. If you are contacted, it's a good idea to make sure that you've got good documentation, you have a good process in place, and you're maintaining good records, whether that's maintaining all of your exemption certificates that have been received, maintaining your general ledger balances and activities, keeping good data reports that support any filings you may have made on the sales tax side, just making sure everything's in order and accessible, and treat the auditor with respect. Having been a former auditor, I can understand why we don't want to treat them with respect, and having been on my side for so long, I struggle. I have to bite my tongue quite a bit. There are definitely auditors that really have no business being in the business. We all know that. And at the same time, there's some good auditors out there that are doing a good job. They're doing what we're asking them to do. And you have to think about it in a couple of different ways. One, yeah, they're coming knocking, and they may have a bill to hand off to you at the end of it. But at the same time, they're also monitoring your competition in some regards and keeping the playing field level. Once the audit is started, you want to control the content. You want to limit the visibility that the auditor has into the overall business activities and the business records. Don't give them everything. They're going to come to you initially with a list that'll seem pretty long. Might be 3 pages of 50 different line items. There are some key pieces of data they really need. Try to understand or determine what those key pieces of data are and provide those pieces to them early and in a complete fashion. There's going to be a lot that they'll request that may not be necessary. You know, they've got this checklist for every company and every circumstance out there. So they're just trying to make sure they don't miss anything. But engage with the auditor on a personal level. Have a single point of contact within the company that manages the auditor. That way you keep all of your messaging consistent. There's nobody telling different stories. There's nobody pointing the auditor in a different direction or showing them different data that they may not need to see. So keep everything sort of contained in that respect. And then if you are going into an audit and you know you've got some really significant risk already on the table, there are circumstances where you might just benefit from disclosing some of that exposure early on, maybe at the very beginning. Now, it might seem silly to do that, but the reality is building a rapport with the auditor and giving up something that is so obvious and that is so likely to be identified by the auditor anyway will only serve you well in terms of the relationship. And that relationship is key because there's going to come a time in just about every audit when there's going to be some piece of data that isn't fitting right or that isn't available. And if you've got a certain rapport with the auditor, you may find it that the auditor's forgiving in that regard, or they're more apt to believe you in terms of whatever story, excuse, answer, whatever you want to call it, that you give them. That rapport you build at the very beginning can go a long way. Auditors have a ton of discretion. Once they start scheduling things, they lose a little bit of that discretion, but they do have a lot of discretion, and depending on how you treat them, sometimes that discretion is used favorably for you. And then lastly, you know, having gone through an audit, you're typically going to get some work papers. Usually the auditors are going to give you a little bit of time to review those work papers and try to mitigate or respond to some of those initial assessed items. But at some point in time, it's going to come to an assessment, a formal assessment. And once that happens, there's a number of things that kind of come into play. Maybe you want to work on some of the items in the work papers or even in the assessment, and you need more time. So statute of limitation waivers are a fairly common practice. More often than not, at least in our experience, maybe not everybody's, usually the jurisdiction needs the waiver because the auditor is either not moving fast enough or they went out of the gate wanting to get an older period and they don't want to lose that period. So there's different levels of reasonableness when you're asked to execute a statute of limitation waiver. I would say 90+% of the time we are going to sign them, we're going to execute them, because the alternative is the auditor can just simply issue an arbitrary assessment if you refuse to sign it. So they do hold all the power in that regard. There are times, though, when auditors are just not doing their job well. The auditor's getting strung out. It's been going on for 16 months, and now they want to sign a waiver to protect their time. It can become a little bit ridiculous, and at that point, you've really got to escalate and maybe talk to their supervisor to talk through what that really looks like. If you're dealt a significant assessment and the work papers are available to you, it's important to kind of focus on what's really important in terms of materiality and what's black and white. You know, what are the things that you feel like you can argue or provide documentation for that will easily mitigate a specific item. So kind of take your time and categorize your assessment into groups that you can articulate your position clearly and efficiently. If you go about it trying to work through a list of 1,000 items one at a time and you want to debate every one of them, the auditor is going to eventually just grow numb to that, and they're just not going to want to work with you anymore. Obviously, you'll have opportunities once you get the assessment to provide supporting documentation in the way of exemption certificates. And there's another concept, we refer to it as an XYZ letter. It's kind of a slang term. Most of the states use it similarly. It's an affidavit, basically. It's basically a letter from your customer that says, yes, we did purchase these items from you. No, we did not pay sales tax, or you did not charge us sales tax, but we self-accrued and remitted this tax directly to the state. Or we've already been audited and the state's already assessed on these items. So an XYZ letter, an affidavit from a customer saying the tax has already been satisfied, can be a mode of mitigation, similar to an exemption certificate. If you're not convinced that the auditor knows what the heck they're talking about, and that does happen, they may be misinterpreting what it is you're selling. They may have a misinterpretation of the way something's written on an invoice that gives them the impression that it's a taxable event. Don't just sit idle while you get assessed. Feel free to ask for statutory support. Ask the auditor, what's the basis for you scheduling this item or communicating that it's taxable? Maybe get the statutory or administrative support for that. Projections, samples and projections, fairly common. Bigger you are, the more likely you'll deal with those. A lot of states are now migrating to a more sophisticated electronic sampling and projection technique. They'll actually bring a specialist in for the larger companies who manages the technology around that. Not a whole lot you can do with those types of programs. They're very sophisticated and very effective. However, there's still a lot of what we call block sampling, where the auditors will take a look at a specific period of time or a specific group of transactions and attempt to project. In a lot of ways, that it's a logical approach and it can be fair for both parties. But there's also a lot of scenarios we found that the projection methodology was flawed and overstated the liability. We found it the other way as well, where it was flawed and it understated the liability. We didn't argue those, obviously, but there can be opportunity to negate some portion of an assessment just based on the projection method. Negotiating the findings, I talk to a lot of companies and I'll hear people tell me, yeah, I've negotiated that audit. I just told the auditor this is what I'll pay and they took it. That's not really what's happening in most states. There are a few states, and under certain conditions, there might be an opportunity to negotiate the findings. And New York's it's a fairly common place for that to happen. The state wants to sell the audit. They want to close the audit. They don't want it to drag out in appeals. So there can be some negotiations. There's got to be some level of basis. I mean, it can't just be that you don't like the number. It could be that it's a financial strain on the business, or it could be that it's very questionable in terms of whether this product was taxable. It's kind of gray, and maybe we come to an agreement to say, all right, I'll take the tax hit for the last 6 months, and you forgive everything prior to that, because this is really a gray area. There are some circumstances like that can play out favorably. So I don't discourage you from trying to negotiate, but don't necessarily go in thinking it's just a matter of like buying a car. You're assessing me $10,000. How about I give you $7,000? We call it even. Doesn't generally work that way.
All right, let's pull up the last poll question here and let us know if you'd like for us to follow up with you or not. And while we have that pulled up, we got a couple of questions, and then we'll wrap up here. So Gail has a question about South Dakota, not necessarily specifically about South Dakota, but it looks like she had economic nexus for transaction purposes in South Dakota. Kind of reading into this a little bit, probably registered for sales tax, has been collecting and reporting sales tax. As you know, Jeff, the rest of the audience may not know, South Dakota repealed their transaction count criterion for establishing economic nexus. Now it's just a revenue threshold. So now she's in this spot where she's registered, has less than $100,000 in activity in the state. What do you do?
Close the account. There's different philosophies. I don't like businesses to go in and out. In other words, be registered for a period of time, and then you drop below the nexus threshold, so you deregister for a period of time. Then you trigger nexus again, and you register for a period of time. That really doesn't bode well for everybody. It kind of makes this fragmented statute of limitations, and it's not a full statute of limitations opportunity. So, I don't necessarily encourage you to just flat out close the account, but under the conditions that have been described here, you would have the ability to close the account. And I would say you could close it effective immediately under the conditions that were described.
Perfect. Amy asked, do all states have VDAs?
Yeah, the short answer is yes. The longer answer is there are some unique unicorns, I'll call them, out there. For example, in California, if you're located within the state and it was a sales tax transaction, they don't have a VDA for those types of situations. I think Hawaii has a 10-year look back. So I'm not jumping up and down doing a lot of VDAs in Hawaii. The way that New Mexico manages it is through what they call a managed audit. So it is a VDA essentially. They just use different language, and it's a little bit of a different structure. And then there are other nuances in other states, depending on where you're headquartered and the types of transactions that are involved. But that's the long way of saying generally yes, you can probably, and if you just write the state and Google Georgia Voluntary Disclosure Agreement, you'll get pretty quickly to what you need to see in terms of validating that.
All right, I'm going to take one more question, and actually the same individual has two questions. And Tom, I'm not going to get to the second one. We might have to have a dialogue on that one. But Tom asked if we have a good resource for, my question panel just changed on me. We have a good resource that shows the taxability of SaaS products. We don't currently, Tom, and we're laughing here internally because we've debated and we're trying to twist Jeff's arm to put a SaaS taxability chart on our website. I think it's forthcoming. We're going to do that. So there would be a taxability chart for SaaS purposes that you can get from our website at some point in the near future, over the next few weeks, I would think. I'll get Jeff's commitment here on the webinar as to when we're going to do it. But the caution there is, and this is what we find when we do these taxability studies, is that sometimes it is really, really clear that you're offering software as a service. And utilizing some type of standardized chart or guide can be very helpful in those scenarios. However, there's a lot of scenarios where we talk with companies and they think it's SaaS and it might look like SaaS, but it's really not SaaS, and what is it? So there's often this effort to figure out, what is it that we're selling here before we try to apply the taxability rules. So again, having a SaaS taxability chart is great if you're 100% confident that you're delivering a SaaS solution, but certainly as software changes, as technologies change, we see new products and new services launched all the time that don't fit into a nice, neat box. And that's where you can get potentially sideways, is applying those standardized rules to something that isn't quite what it's meant to apply to. So with that, I will go ahead and wrap up. I know we've got a couple of additional open questions. Feel free to email us or reach out to us. We'd be happy to address those. Appreciate everybody attending today, and hopefully we'll have a chance to either see you on one of these in the future or talk with you here in the near future as well. Thank you.
Thanks, everyone.